thank you to Convergence for having us. I'm Caitlin MacLean, Managing Director at the Milken Institute. We're a financial and economic think tank, and have been working in blended finance and helping to structure different investment funds, especially around areas of climate-smart infrastructure, whether that's kind of on the power generation or opportunities like resilience, which actually the insurance panel just before us was very timely. Very excited to have a panel here today to talk about the variety of tools that blended finance offers for climate-smart infrastructure, where those opportunities sit today, and where there might still be some lingering challenges where we need better partnership or better structuring of funds to really move the capital to where it needs to go. So let's just dive in. I'm not going to do kind of very deep introductions just because we have a limited amount of time and a brain trust on this panel. So Stephanie, why don't we start with you? You offer a wide variety of tools at KfW. The German government has done a significant amount of investment over the years, especially in blended finance. But talk a little bit about where you've seen the best use of those tools for climate and climate infrastructure in particular.
Yeah, first of all, thanks a lot for the invitation. It's great to be here on the panel. And probably I'll start with a few words about KfW Development Bank, because I'm not quite sure how familiar you are with the institution. So we as KfW Development Bank, we are part of KfW Group, the German state-owned promotional bank. And as our name says, we as the equity and fund department, we are responsible for initiating and investing in equity and funds in emerging markets. So as of today, we have approximately a portfolio of 6 billion euros, split over approximately 80 funds. And we are doing the whole range of funds. So we are investing in equity funds, and debt funds, and specialized funds, very often combined with technical assistance. We, as a state-owned bank, we work on a strong mandate of the German government and of the European Commission. So approximately 80% of our funds are from the German government and to some extent from the European Commission. And the expectation in this regard is that the capital is flowing back in a base case scenario. However, we don't have hurdle requirements, and the key intention is, and the key mandate is that we invest in impact and that we mobilize private capital. So you very often see us as a risk taker. So about 70% of our funds, we are the first loss provider in order to provide acceptable or attractive risk return profile to private investors. And I will come to climate quite shortly. So we distinguish between two main groups how we could mobilize private capital. And I start with, we call it direct mobilization of private capital into the funds. And these are the so-called structured funds, where you find us, in most of the cases, as a first loss provider in order to provide an attractive risk return profile to the private investors. And I like to mention a climate fund, which we recently did together with Responsibility, Swiss Impact Asset Management, which is the Asia Climate Fund. The Asia Climate Fund is a fund which invests and finances projects in renewable energy and energy efficiency and e-mobility in Asia. And the structure works in a way that there is a condition that at least 50% of the capital need to be first loss capital in order to provide a risk mitigation to the private investors. And as of today, so the fund has been launched about 18 months ago. The total fund volume is for approximately 400 million. We have a first loss contribution of 20%, and more than 200 million are coming from huge financial institutions, which is a great success. But besides the structure, the first loss structure, the key success criteria was, of course, that it's a very experienced impact asset manager, and that there was already a substantial product pipeline available before the first close. So that were really the success criteria. So coming back to the two main groups of funds, that these are the funds where we speak about direct mobilization of private capital into the funds. The other group is the so-called, we call them ecosystem funds. There you probably don't see the private investors directly into the fund. However, the fund's mandate is to create ecosystems which are investable for private investors. And I'd like to give some examples here. So we already spoke a lot about the challenge of local currency. So we are a key anchor investor in the TCX fund. I think most of you know the TCX fund. And the mandate here is to provide local currency solutions where no solutions are available in the capital markets in order to allow the private investors to invest in the respective markets. The second example is risk insurance. So actually we are a big fan of risk insurance solutions. So we have set up several funds which provide risk solutions for private investors, in particular with regard to climate risks, so provide policies which give climate insurance to private investors who like to invest in markets which are opposed to climate risk. And the third one is guarantee solutions. I don't want to speak so much about that because that is something my other panel participants will do. So what is our intention here? We are acting as an anchor investor in guarantee platforms. And the guarantee platforms provide guarantee solutions, for example, to FIs, to microfinance institutions in order to extend their loan portfolio. And when we speak about mobilization of private capital, I think it's very important that both solutions are necessary. So the direct mobilization of private capital and the ecosystem funds. And we already spoke a lot about standardization, and I think that is in particular very important when we speak about climate finance. And I'd like to share one conversation I had with a CIO from a huge European insurance company about 18 months ago. And actually I asked him, what do we need to do in order to get more funds from your company? And the answer was, the blended finance structure is perfect, so we see that we have an attractive risk-return profile. However, you know, when I have a look at my desk, there are 9 potential solutions how I could invest my money. And when I have a look at your transaction, it will take me 9 months of due diligence. If I have a look at the other solutions, probably it will only be 3 months. And if I decide to go for the impact fund, I spent the 9 months, I did it, and then there comes the next solution in impact financing, and again, it's a completely other structure, and I need to invest again 9 months. So that is really, really something where I need to allocate a lot of capacities, and probably you'll do it once or twice, but probably not the third time. And therefore, and I think we already had many discussions about that this morning, this afternoon, and yesterday, the standardization is really, really important, in particular when it comes to huge fund investments, which we particularly see in the climate space. And I'd like to briefly mention here Scaled. Scaled is a public-private stakeholder initiative, which intention is to build a platform where the funds are bundled in order to provide capital on a standardized basis and on a scalable basis. So that is an initiative which has been initiated by Allianz, by Zurich, by AXA, together with Canada and Germany. And it has been launched on the last Hamburg Sustainability Conference in June 2025. And the intention is to establish the platform in the first half of 2026. So I think all 3 components are really, really important: the direct mobilization of private capital, the ecosystem funds, and in particular with regard to climate finance, standardization, scalability are really key.
Amazing, thank you. Yeah, no, that's a tremendous amount of work you all have been doing. We'll get to the standardization piece a little bit later, but since you brought up guarantees, Lars, you're sort of the godfather of guarantees, I would say, in the best possible way, not like a creepy godfather. or scary godfather. As Stephanie was just saying, there has been a challenge and a perception early days that, if something doesn't look like what I am familiar with, then I don't want to use it or I don't want to invest. And that path of least resistance has changed because of work like you to make that a product that looks more familiar to those who are using it. So I'd love to hear your thoughts about kind of the evolution of guarantees, especially for climate, and where you kind of see that market now.
Thank you. You'll need to point out who made that comment about me, because I'm not happy with that one, but anyway.
It's in the bathroom wall. What? No, just kidding.
But it is true. I cannot deny I've been working with guarantees for about 15 years. So I've probably seen most situations where they can work and where they can't work. In terms of the climate sort of space, what we found was that actually there's an amazing database out there, which is owned by Moody's, and they've been tracking infrastructure and project financing loans for over 20 years, both in developed markets and in emerging markets. And they even segment down to climate infrastructure. And what that data says is that climate infrastructure in emerging markets is no more risky than climate infrastructure in developed markets. So this is not MDB data that we're talking about. This is banks, commercial banks lending to infrastructure in EM. And we were able to take that data and say, well, actually, that's true. We don't need concessional capital. We can create a guarantee company that is entirely focused on being a commercial private sector-driven entity. And that's what we've done with the Green Guarantee Company. So what we found was, and this speaks to the experience Stephanie had with your global CIO at the insurance company, when we went to the private sector and said, hey, do you want to put some capital to set this up? And it was like, no, that sounds like a bad idea, right? It's a perceived risk. It's still an issue. So what we have done is we have got capital from the Green Climate Fund, from the UK government, from the Norwegian government, and the Nigerian government through their Sovereign Wealth Fund to set up the Green Guarantee Company. But it's set up on an entirely commercial basis. All of those entities that I just mentioned are coming in on a fully commercial basis. There's no concessional capital. They want their money back with a commercial return. And we have been able to get a rating for this Green Guarantee Company based on that data that I mentioned at BBB stable. And what actually surprised us even more when we went to the market was the investors love that. Because that's actually the minimum they need. They don't need AAA, right? They actually want to make a return that they want to yield. So if you give them a AAA guarantee, what are they going to do with that, right? So we have been basically building a pipeline, and we're hoping now the first few deals are going to close just in the next coming months. And it's been really interesting. The opportunity there is huge. There's a lot of projects out there. The challenge and the drag factor that we're finding is actually getting borrowers to get ready to step up. Some of these companies are incredibly sophisticated borrowers in their own local capital markets. But when they have to step outside those capital markets local capital markets to go to the global capital market, that's a step change that they're not ready for yet, right? And so where we see the need from the development finance community is to actually help in that sort of preparation, borrower readiness preparation. That's where technical assistance can be incredibly valuable and powerful. I was just giving an example that we deployed $100,000 of technical assistance to mobilize a $50 million bond, right?
Amazing, yeah.
And so the last point on standardization is that actually the products that we're selling are bonds and loans. These are things investors don't understand. Very simple, not complicated for them to understand, right? And the standardization works at that level. That's where it needs to be. Where we feel the funky stuff happens to happen, the blended finance can happen, is actually at the project level, right? The investors don't need to know about that,
Right. I was going to ask you, actually, if you could give one or two examples quickly of, even if the projects haven't closed, you can talk in generalizations of what these types of projects look like in terms of the subsector of climate infrastructure, but also kind of give a sense of scale and scope of the projects.
So that's a really good question around the one-to-one scale, because when you talk to the global investor community, they're like, listen, we want to be deploying hundreds of $1 millions in one deal. And then you start looking at the pipeline and you realize actually that the natural deal size for the global capital markets from a borrower perspective is about $50 million.
Right.
Yeah. So there is a discrepancy there. So we have had to do a lot of work in this last year, and we see that as part of our mandate in terms of who we are, to work with investors and get them to start thinking about moving down, understanding that actually they need to help build this market. And I mean, if I reflect on the last 12 months, if you'd asked me in January, what I was very naive to, I would have said at that time, was that I thought we were simply providing a tool to a market that already existed. Actually, what I've learned in the last 12 months is this is a market that does not exist. It's a patchy, occasional market that comes into play. And what we have been doing progressively over the last 12 months is understanding all the friction points of this market and slowly finding solutions to that so that we can create flow. And that's really ultimately what will be the key success that we're going for that.
Yeah, it's great. Maheen, maybe you could weigh in here. Obviously, at Infra Zamin, looking at Pakistan as an example, kind of talk a little bit about what Las just mentioned in terms of the challenges of kind of going from your local capital markets to the global capital markets, and the work that you guys do to guarantee that process isn't, I think you said bad, but hard, right? It's the perceived difficult level for investors to invest in.
Sure, no, thank you, and thank you to Convergence for having me here today. So I'll just take a bit of a step back and talk about the actual scale of the problem as we see it in Pakistan. So we have a fairly large 250 million population, middle-income country where the average bank lending to the private sector is close to 15% of GDP. And you compare that with other emerging markets that are in the 50 to 60% bracket. So you can see the degree of market failure that actually exists in the country today, which is one reason why PIJ selected Pakistan to be the second credit enhancement facility in its portfolio. I think when we're now 5 years in, and when we look at the number of projects that we've done over the last 5 years, the guarantee now is not just the de-risking instrument. So what we're seeing now is the guarantee is a signal to the market, and the signal is twofold. One, that guarantees and lending can happen in a commercial sense, because every project that we do is commercial. And second, the guarantee can actually open up a very underbanked sector of the economy, which is quite vital for that development to come through. And because we do it all in local currency, this becomes a very popular tool for local private companies, as well as local banks, to use the guarantee to move into that lending space, which, as you can see from the numbers, was quite limited in the past. So, what have we done to date, and where have the biggest sort of successes been? I would say one of the things that we've seen tremendous traction is on the capital markets development side, particularly looking at bonds which previously were either not issued or not issued by certain sectors of companies. I think one of the key things that I personally am very proud of was the gender-linked financing, or the gender bond that we did almost 2 years ago with the Kush Foundation. And that came in the wake of, as you know, Pakistan is a very climate risk country, and we had massive floods in 2022, which destroyed over 1 million homes. And we actually, tied up with a microfinance institution at that time to rebuild those homes using the bond as a micro-infrastructure play. At that time, we thought that we'd impact about 30,000 women. We're now 2 years into that bond, and we're going to cross 50,000 women that have been positively impacted by that kind of financing. And not just that, but we've actually opened the door to a number of other gender-linked financing in the country, which actually didn't even need the use of the guarantee. It just needed to be shown how that kind of risk could actually be borne and structured. And if we look beyond that, we have also done green. So we've done green financing in the telecom sector, and we've also done sustainable financing via the capital markets on agricultural infrastructure and storage and processing. So I would say those are some of the key big challenges, big opportunities that we saw. Now, where are the challenges and where are the issues that can come across? One, guarantees can't be used for every single new thing that's coming up, and we do need the early stage, the venture capital, the equity investments to really look at the new sort of technologies that are coming out and desperately need that financing as well. I think one of the discussions in the lunch break was also nature-based solutions, which are highly needed, but very difficult to do in a pure guarantee or social format. So I think there's still some innovation that we have to do, but by and large, I think the guarantee has certainly helped unlock tremendous potential that we can see in a number of the difficult sectors, in particular financial inclusion, agri-storage, even digital infrastructure. We've done several transactions on those as well.
Excellent. Yeah, as you mentioned, one piece of the pie, right, but an important piece that can hopefully be expanded, and we can talk about this a little bit later, into different sectors. Just what do you need to really make that a reality? Jim, we've been talking a lot about how to get more private investment and to de-risk some of these projects and some of these investment opportunities so that the private sector is more comfortable. Would love to hear from your side, as you guys obviously are a manager in the climate space. Would love to hear kind of what you're seeing in terms of interest from investors, as well as some of those knee-jerk reactions that we've heard from Stephanie and Lars of maybe this doesn't look like every other apple in my portfolio, or this is kind of harder than it will be comparatively to another opportunity. So would love to hear some of your thoughts on that.
Does it work now? All right, sure, thanks. So I'm a climate fund manager, so maybe one step back. For those of you who don't know us, we are a joint venture between FMO, the Dutch Development Bank, and Sanlam, the largest non-banking financial service provider in Africa. And what we do is we structure and raise and ultimately deploy blended finance vehicles to invest in global emerging markets, all climate relevant infra. At the moment, we manage around 2.7 billion US dollars, coming from the Dutch government and the Green Climate Fund, all the way to Scandinavian pension funds and Dutch banks. It's 3 equity strategies on renewable energy, water infrastructure, hydrogen, and then more recently also a debt strategy, which we closed 2 days ago, called Gaia, together with MUFG, FinDev, and the Green Climate Fund. We're quite a strange or, I guess, niche fund manager in the sense that we're accredited with the European Commission. So we're a pillar-assessed entity, which allows us to manage guarantees of the European Commission directly. And knock on wood, will be accredited with the Green Climate Fund soon. Within CFM, I'm mainly responsible for developing and raising these entities up until a close, when we hand them off to the deal teams who do the actual complicated work. I think what we've seen over the years and since our inception, what has really changed in terms of investor demands are 4 things. It's more, but it's 4 that I'd like to mention. And the first one is on going from global emerging markets to regions. So during our first close, or when our first close happened in 2016, the world just came out of the Paris Agreement, and the main thing donor countries wanted to do was help the Global South reach the national determined contributions by providing concessional capital and getting private sector financing. And this worked well for us, fundraising-wise, because for large institutions in developed markets in Europe, in the US, diversification was a great argument on why this had to be done and why this could be done. What we've seen, however, over the last few years is that a lot of the donors have really narrowed that scope. So a lot of, I would say in Europe, we see a lot of focus in Africa, on LDCs, on the Sahel region. In Asia, I would say many of the donors are looking at the Asian continent, and in America, it's often Latin America. And this is, I think, a good it's good progress in the sense that it ensures country ownership, and it ensures a lot of these RFPs are really tailored towards local problems, right? It makes sense to raise an adaptation fund for Bangladesh. It might not work in terms of standardization, because I guess these vehicles do get smaller and more bespoke, but I get it from a country ownership perspective. Another thing that happened because of that, because we're changing our strategies from global emerging markets to local, is that we see a lot of more of local appetite. So a lot of pension funds or investors are, by regulation, restricted to invest outside of the country. And in a lot of African countries, this means a lot of these pension funds did not have any access to blended finance vehicles because they had a global EM or at least a continental approach. And us changing strategy, so for now our latest equity strategy is focusing South Africa and Namibia, has allowed us to onboard PIC, who are representing the largest African pension fund, which was a big win, especially seeing the nascency of the sector. And I don't think any institutions in Europe or the US are as progressive as that. Then a second, slightly more alarming trend or change that we've been seeing from our investors is on national content requirements. So a few years ago, or say 10 years ago, it was very clear that anyone investing in the impact space was doing this with a good heart, and the end goal was creating impact in the recipient country. Well, now I think a lot of the conversations are a combination of both. It's about helping the country, but it's also helping in creating local or national content. So think of shareholding, or think of European or American technologies or EPC contracts. But in a way, investors are requiring this. And I understand it, because it's probably a way to channel ODA through complicated geopolitical times. But it doesn't always serve or gets to the best outcome. Right? If you think about blended finance or what our funds are trying to achieve, it's financing assets that are not yet bankable or close to bankable, but the business models are difficult, and making them more difficult by not choosing the best entity to do it, but by choosing one that's from a certain country, isn't helping the project. And from a fundraising point of view, and which is giving me a headache, is if you're trying to raise $1 billion fund, you're going to have different continents or donors coming from different continents, and it gets quite difficult to promise European content, Japanese content, and American content in the same vehicle. Then a third trend that I think we've been seeing, and how blended finance has been shifting, is in governance. So when we started CFM, we really had an open architecture. So our investment committees and advisory boards, we opened everyone above a certain threshold of investment. But you get very fruitful but also complicated discussions, having a guarantor, 5 donors, DFIs, and Scandinavian pension funds all in the same room. They clearly have different preferences and expectations. So we've tried to narrow that down to a more discretionary standard, the manager gets to decide model. But we've been having a lot of pushback from our donors on this, and this is becoming more of a trend. And it gets very hard for us to explain to commercial investors that donors get opt-out rights or can excuse themselves from certain investments. So we have the structure around it, and we do that by feeder entities or having governance on project level. But in the end, again, on the standardization, I don't think that's an outcome we should want. It's just making these funds very, very complex. And then the last instrument, or last change, and then I'll stop talking because I have a very daunting clock in front of me. But I think what we're really seeing is a change in financial instruments. So we're grants and equity from donors. It's moving into more debt-like instruments. And for commercial parties, it's more and more about yield and liquidity, rather than returns, I would say, which is making equity strategies difficult, which I don't think is a good outcome either, because at least from a manager point of view, having an equity, and especially if you're an investor of majority or significance, it's where you're most additional and you change the projects and structure them in a way you would like to see them from an impact, ESG, as well as financial point of view. But yeah, those would be the 4 biggest trends in how we've changed thinking about structuring our funds.
Yeah, very helpful. And I think everyone has brought up standardization. Obviously, there was a panel before around standardization. So would love to hear some thoughts, because when we're talking about climate smart infrastructure, in theory, that could be everything from traditional kind of solar and wind to, mining critical minerals to adaptation and resilience in terms of climate-friendly agriculture or better wastewater management. I mean, there's a wide variety of projects, and you are trying to make, many of us are trying to make many donors happy and many investors happy and measure the impact and do right by the community and the project. So would love to hear some best practices of how you integrate in some of the metrics or data that you use to prove out the kind of climate friendliness of the projects, understanding that there's not one definition and will never be one definition of climate friendly. So Las, how do you think about that?
So the way we've addressed this is basically by going and getting the Green Climate Fund as an anchor investor in that fund. And so we've adopted their approach to assessing what is climate. And on the basis that pretty much all our other investors are related in some way to the Green Climate Fund, i.e. they put money in or are a beneficiary of, they've all basically come around that. So that's proven to be a very successful strategy, notwithstanding that the Green Climate Fund is has very stringent standards around climate and processes. But fundamentally, though, that's been there. And I think if you are setting up a blended finance fund and it's thematic, it really helps to go and get what we would call an integrity partner in the sense of somebody, an entity that really is seen to be at the forefront of that, like we did with the Green Climate Fund. And we're looking at setting up other guarantors around other themes. And again, we're replicating that approach of getting an organization that is just seen as best as class at doing that to be part of our structure.
Yeah, that's a great point. Stephanie, I don't know if you agree. I mean, KFW honestly is often seen as sort of a leader and kind of a stamp of approval for other donors, but curious your thoughts about, kind of who do you look for that industry standard that Las was speaking about? Or are there other ways that you guys think about kind of not being so stringent with the metrics or as stringent as you need to, but allowing for flexibility to ensure that there is impact, but also that you can have a diversity of deals? You just start talking.
Okay. Yeah, very, very happy to answer that one. So first of all, I think it's really important that there is a bigger alignment between the different investors. And speaking about reporting requirements, regulation, currently it works in a way that a fund investor or guarantee platform has different donors as investors in the respective platform or fund, and they receive a reporting requirement package from each of the donors. So that really keeps them busy. So I think it's really important to find an alignment here to implement more standards in this regard. And I'm fully aware that we as KFW, we have very specialized requirements as well. So probably we are becoming a pain from time to time as well. However, I think it's very important that there is more alignment. And coming back to climate, how we are evaluating that, we have key KPI requirements from our respective funders, so from the German government, from the European Commission, which we use in order to classify the respective fund as a climate fund.
Maheen, have you also seen that it's, as you were mentioning, the gender bond and being able to quantify the amount of women affected and then seeing the advantage of the rebuilding? Would love to hear how you all are thinking about kind of the next generation of data that you need or impact measurement that you're going to be doing. Obviously there's AI and a wide variety of technology that is going to be beneficial to kind of telling that story, but would love to hear kind of your thoughts as you're doing so much in a wide variety of sectors.
Sure. So on the standardization, we do follow PIDGE and FCDO aligned sort of templates. And those have been very useful as a screening mechanism in terms of the number of projects that obviously come to us, the ones we look at. They do provide a very good screening mechanism for seeing what we can do versus what we can't do, because I think while you get a lot of projects, not all of them carry the kind of development impact that you want to see. How we intend to refine those further is going to make it much much more local. So we will take the global standard, we will bring it down to the local level, and we will say, particularly in our context, what makes sense in terms of the climate piece. Are we really looking at mitigation now? I mean, most emerging markets are not huge carbon emitters, and so the requirement for adaptation and resilience finance has certainly gone up. So how do we include those measures within our screening mechanisms? The other areas that we've looked at is actually AI, particularly in terms of battery storage and how we can use that to offset the variability on solar panels and adjust that through battery implementation. So we've actually gone and done that kind of project in the telecom space, which is proving to be quite successful. So I think it really calls for a much deeper localization of different aspects that we can build in. And within that, I do think we have to be careful not to get too specific on everything, because then we'll end up excluding things that may otherwise be relevant as well. And I think that's on the front end, but on the back end, and while I love all the lawyers in the room, I do think that on the back end, when it comes to documentation, a tremendous amount of time could be saved by looking at how we can standardize the documentation that we require, not just for guarantee issuance, but also for a lot of the cross-party relationships that we have to develop within this as well.
Yeah, no, lawyers and insurers, right? It's like any time they're in the room and you're like, okay, no, thank you. We need you. We need you, of course. You're fun at parties, right? No, I know, we're serious. Jim, would love your thoughts there. Maheen was just mentioning the local, metrics and importance there, and you were talking about different interests in terms of geographies. What are you seeing from investors in terms of demanding some of that kind of local information, local data, kind of local impact story?
I would say it depends a lot. Probably from commercial investors, slightly less so. DFIs a bit more, but where it really, it gets into the grids are donors, and then most specifically the Green Climate Fund, I think, on a project-by-project level have very rigorous reporting requirements. So as an example, for any project we do, we need to agree to a measurement, reporting, and verification protocol with the GCF, which becomes a 30-page document, just to measure on a project level ex ante and ex post, and then evaluate the metrics. And I do think it's something troubling in the sense that it at times questions how cost efficient these blended finance models are, right? You have to think of it. The GCS provides you with a concessional term. You take that on as a manager, but there's extra cost to it. So our reporting department is probably around 5 times as big as a normal PE manager. And at some point, especially with the GCS of this world, reducing concessionality or reducing their benefits, it's a balancing act.
Right. Have you ever had an investor, commercial investor, so not the DFIs, say to you, I want more information on the impact? Said no one ever, or maybe they're coming around to it?
I'll take pride in CFM's reporting. So I think we really report on a lot of impact made. And clearly they really like this. Well, maybe as an example, we took all our investors on an advisory board in India, and we went to one of our projects where for every project we have a community development program. And they didn't realize they were financing a school in India next to the infrastructure project, or the wind turbines as well. And this left a very good impression. Yeah. So I guess we could have done better even.
No, that's a great story, though, but you were doing it, and so, that's exciting.
I didn't realize.
Yeah. So we're coming down to time, and I think we did want to leave some time for Q&A if the audience is, kind of thinking about questions. But in the meantime, while we're waiting for them to, kind of get their thinking caps on, would love to hear what you're seeing in terms of the subsectors in 2026, kind of moving forward. Where would you like to see more blended finance? In what type of sector or in what type of country? Kind of talk a little bit about where you really see that there still is a gap that blended finance, in particular for climate, could fill. Maheen, why don't we start with you?
Sure. I think for us, at least, digital and platforms, because they are trying to fill the gap in a number of social services, for example, medical, education, healthcare, and those areas are largely sort of absent in the Pakistani space from regards to government provision. But we are seeing a lot of startups, we are seeing a lot of platforms, a lot of aggregators that are looking for that longer term financing now, and we can qualify them sort of as digital infrastructure. So I think that's something that we're quite excited to get into and see how we can progress that sector too.
Stephanie?
Yeah, I'd like to come back to the fund which I just mentioned, the Asia Climate Fund. And when I said what was a key success criteria, of course, that was a blended finance structure. However, there was a good project pipeline. And I think we really need to see more financing of new projects, in particular when it comes to product developers. So currently there is a kind of trend that even DFIs are stepping back from equity investments, in particular when it comes to product development. So what I believe is key, what we need to see in the near future is more investments in this space.
That's great. Last.
So, cooling. I actually think that it is such a critical sector that actually impacts education, healthcare, all of the other sectors, and particularly food security. I mean, I was astounded to find that 50% of crops produced in Africa go to waste because of the insufficiency availability of cold storage. And it's a sector that absolutely everyone seems to be ignoring at a grand scale. There are individual projects that seem to be getting done, but there seems to be no integrated strategy around that from any of the MDBs, at least as far as I can tell.
Yeah, fantastic point. Jim?
I agree with Las, but let me add two to them. So I think the two we've identified and where we're, for one, raising a fund in, and for second, looking at one. The first one is in hard-to-abate sectors, so industries. Think of cement and the steel industry, and they're not the most sexy investment, so to say, but it's where double-digit emissions in the world come from. And I guess a lot of the technology there is green hydrogen and derivatives of that, as well as energy efficiency, like carbon capture and making industrial processes more efficient. And then the second one that we've been looking at are supply chains, and then mostly into ports and shipping. So it's really, the sectors that now, from a financial point of view, don't really make too much sense to decarbonize just yet, but where 40-50% of emissions are actually coming from.
Amazing. So do we have some questions from the audience? You're getting a coffee break after this, but we're locking the doors until there is a question. No, I'm just kidding. Right here in the front, yeah.
Thank you. My name is Fernando Neri from Bolivia. We have an asset management fund. But I'm curious to Maheen in Pakistan. After you solve the problem of building the houses for the ladies who lost the house, have you thought on the next flood that's coming, and how are you going to prevent that? And who's funding that? And is there a guarantee fund for that? And is there insurance for that?
I think that's a great question. So Pakistan's actually had a flood every year for the last 10 years. And surprisingly, the government doesn't seem to do much about it. But the way we are kind of trying to tackle that is through solutions in specific regions and specific areas. I think some of it is just climate and nature-based, so you can't do much about it. But I think when it comes down to protection of whatever we have rebuilt in that space, the capacity building and the education piece around where your house should be, where your warehouse should be, where you should be building, it should not be on the riverbeds in the dry seasons, et cetera, right? So there's a lot of capacity building and education that we've done subsequent to that transaction as well. One of the areas that we're looking at, in fact, we're looking at two. One is on water and water storage to see how you can develop mechanisms, not necessarily for the large dams, but at least looking at reservoirs that can capture, because we do waste a lot of that water when we have floods. And the other area is on food security and warehousing, and trying to create portfolio structures with financial institutions on how warehouses can actually be renovated and built in areas where there could be food security issues in the case of a flood, etc. So various mechanisms that we are exploring, and I think over the next 1 or 2 years, you'll certainly hear about some of those coming out.
Wonderful. Thank you. Thank you.
And I would imagine a good opportunity for blended finance in particular. Other questions? If not, we're going to do a final rapid fire. Okay. So rapid fire to get to the coffee break. So Jim, you mentioned different corporates and hard to abate sectors. Curious from each of you, who is someone, an investor, an industry, a potential partner who should be more active in blended finance, whether it's guarantees or other types of products, but isn't? The last panel was about insurance and how to get the insurance industry more engaged earlier into different types of funds, whether they're investors or they're issuing, kind of parametric insurance or things like that. Would love to hear other thoughts from folks about, is there one, type of investor or industry that you think needs to be more engaged in blended finance as we create these structures? Jim.
Well, in general, I'd say it's the larger commercial and institutional investors in America and Europe. I mean, they are investing in blended finance structures, but it's most often of their impact buckets that are like 1-2% of their entire balance sheet, and the actual money isn't flowing yet. So easy answer, but I'd say any commercial and institutional investor.
We just need to design the funds that make it as easy for them to do the diligence that's not going to take, kind of more time than a traditional fund, right? So, Stephanie.
Actually, I see two parties, and that in particular against the background as we have seen a very strong decline of donor capital during the last 20 months. So overall, there is a decline of approximately 30% of donor capital available for impact investments worldwide. So I think in the first step, we need to find some alternatives for catalytic capital. And we are very happy that we see that the foundations, in particular the foundations from the US, are really stepping up. So that's the one side. And on the other side, I think everybody here in the room is aware that the financial gap in order to achieve the SDGs is getting bigger and bigger. So we really need to attract the bigger institutional investors like insurance company and other institutional investors in order to I won't say to close, but to decrease the financial gap.
Great. Maheen?
So I think it's twofold. I think one, yes, commercial institutions, both in country and global. But I do also think, and I'm sympathetic because I'm coming from that side, that incentive structures that are created through regulation or created through, the right policy metrics are vital in encouraging that commercial capital to end up in blended finance. So on both sides of the coin.
I have a slightly different perspective, actually. I'm with Maheen, actually. I see commercial investors wanting to play a role. I actually think the DFI community needs to think about their behavior in terms of the crowding outside of it, because they need to earn a commercial return. And I've seen too many examples of where a commercial investor is really keen to come in, and a DFI comes in with some sort of concessional support to loan, and effectively crowds them out. And there's unfortunately no regulator in the DFI industry to call that out, but that means the DFI is under a moral obligation to self-correct and self-regulate themselves, and to use their very privileged positions not to be coming in and applying their subsidy where it's not needed.
So it sounds like using the right tool, expanding the tools that we have, scaling the tools that we have, certainly, creating new tools, focus on cooling, and resilience and adaptation, and now you get your coffee break. So please join me in thanking this amazing panel.